you see how fast we've gone up and how short of amount of time we've gone up? Look at this. We went over 83% in the SPX in just over a year. Look, guys, together we're going to go. And first of all, thank you for tuning in. Let's go back in history and let's look at exactly what everyone was thinking back during the dot-com bubble. Okay, so as we can see, yesterday I shared that this was a trend line from October 1998, right? So now let's bring this back to October 1998. Let's see what was going on during this time, okay? So we take this point right here. We see the percentage move was approximately 165% increase over 3 years. Obviously, it's not the same, but at this point in time, every single stock essentially was trading above its book value. These companies were completely overvalued. Everyone thought, there's no way, I mean, obviously people bought into the hype, but these companies were not trading at their book value. Very similarly to today, okay? This candle came, the market fell approximately 15%, 14%, right? So let's zoom in on this and understand the trader's mentality here. Okay, so all of the people that were long here, after this big, large candle, it had a low of 957.4, right? If you were long, right, if you were to buy here, right, your stop loss would be 957.4, right? That's what a trader would essentially do, right? The next month in September, they broke that stop loss to 940. Okay, so they deliberately brought it lower, right? And then everyone was like, okay, now we're gonna go and we're gonna have a stop loss at this point right here, okay, which is a new stop loss. So the next month, everything looked fine and dandy, and it ended up breaking that stop loss as well. So this is October 1998, where everyone was like, look, we broke both stop losses. Bulls were completely just getting eradicated at this point, right? And the last thing you would have thought would happen from here, right? We increased another 67% in approximately 2 years, right? Which is completely, it didn't even make sense rationally because there was already so much money that was made during this time. All of these companies were completely overvalued, right? Very, very similar to today's time. There's no one even fathoms these companies' valuations right now. So what I wanted to show was that it's very similar to today because as we can see, we're just now approaching that level, right? Everyone thinks, look, there's no way that the market can continue going upwards. There's absolutely no chance, makes no sense. But what you have to realize about today's market is that when you have, first of all, the new technology, right? There's such an influx of news, and everyone has so much more information today than they did in the 90s. It's much more easier to persuade people and get people, to have a more bullish or bearish outlook on the market, right? You have the Fed, the chair of the Fed giving speeches every week. Okay, so the market conditions are completely different. There's quantitative easing happening every month. There's the backing of the government. There's backing of the Fed. There's backing of all of the international freaking central banks all around the world to make sure that the equities market specifically, so this is the equities market, stocks, they're making sure that the equities market does not implode on itself. Because currently, yes, from an economic standpoint, we are not in good economic standing, right? But the equities market does not reflect that. We are at new all-time highs. So we have to keep an open mind to everything that's going on. If you were trading this market as an economist and you wanted to short every single time, you would have lost all of your money because you have to learn how to adapt to different market environments. Okay, so as we can see, the SPX is now just touching this level of resistance. Potentially, we can see much higher levels. Obviously, given logic, and I mean, I wasn't trading back in the 90s, so it's much more scary to go long the market currently. But we have to keep an open mind. we absolutely have to keep an open mind to the possibility of this level being broken. And I think the best way to do that is we just blindly trade the levels at this point. We have to understand that there are computer algorithms that are designed to buy and sell at certain points. So essentially, that's the best that we can do currently. So yeah, there's the chart of the SPX, the NDX, the Nasdaq, very similar. So January 1999. Let's go ahead and look at what happened here on the Nasdaq. It's going to be much more. Obviously, the percentage increase would be even higher. Over here, January 1999, right? This is the so I showed you October 1998 on the SPX, right? This is where that little level was. So now January 1999, everyone was like, okay, look, this year we're gonna have a correction. Okay, there's absolutely no way that this is going to sustain itself, and it really barely did. We barely moved for the entire year, almost essentially, right? And then came October 1999. Once we broke that level, we went up another 92% in approximately in less than a year. What was that? Less than a year? Yes, in 5 months. Okay, so so um, as we can see in the past, things have been much crazier. Okay, so things can still get much more bullish. So it's still very important to understand. Like, look, we still have a lot more upside room. Okay, I spent a lot of time explaining this, but look, we're still at these levels. There's still a lot more upside room to go, regardless of how overextended you think that we are. The more the market can just continue surprising you, and you'll just end up losing all of your money. Everyone that wanted to go short here, just imagine you imagine you went short during the .com bubble and you didn't make any money. That would suck. Anyway, that's where we're at currently. We can still potentially go much higher. So it's safe to keep an open mind. All of the people that kept an open mind over here, when all of the companies were not trading at their book value, made a lot of money because they kept an open mind and they just traded against the levels. So that's essentially what we need to do here. And yeah, I just wanted to give a little history lesson, and let's go into the chart for the Russell. Okay, so now the Russell I showed yesterday, obviously the from the March bottoms, right after the financial crisis, we drew a trend line of support. We still haven't even reached this level yet on the Russell 2000, so we are still lagging behind, obviously, growth and the SPX. Okay, because on the SPX, the March level was down here, and we crossed above that already. And the NDX, we are far beyond that level. So the Russell still has more room to go potentially. Okay, so now let's look at the S&P 500, the SPY on the daily chart. Let's look at what happened today. So, all right. So here's the SPY. Okay, so again, we're still pretty range bound. This is the level from the March 2020 bottoms, and this is the trend line that we created. We fell out of it in early March, and then we reclaimed it. So now this level is acting as support. Okay. One thing that I wanted to notice today was the 10 simple moving average acted as resistance today for the S&P. The SPY, it still needs to hold essentially 388. If 388 holds, still think things still look pretty good. But another thing that I want to look at is today we reclaimed the 23.6% fib level. So at the start of this month, if you created a Fibonacci level from March 4th to the most recent highs, we reclaimed the 23.6% fib level. Okay. So, we're just trading it one day at a time. You go long, we could just buy the dips on basically everything. And then if, these key levels of support start to break and these trend lines begin to break, that's when you start to look to be bearish. But again, if you wanted to become a contrarian and you were like, no, there's no way that we can just continue going up this entire market, blah, 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 you would have lost. You would not be trading right now because you would have lost all of your money trying to short every single rally. And yeah, so it's very, very important to keep an open mind when we trade. Okay, you got to let your ego at the door, and you have to be. Look, I could be completely wrong tomorrow. I have to, as a trader, you have to understand that you can be completely wrong in 1 second, and you have to make the right decision in the next second. All right. So there's the SPY, right? So now the QQQ, everyone was talking about how, the inverted head and shoulders pattern on the NASDAQ. Boom, that's a bullish pattern, right? And it gives you like a price target of 350. The measured move on the NASDAQ would have been 350, right? Today, it stopped exactly at the 50 simple moving average on the NASDAQ. Okay, so I went long as we crossed over 318. I took some profits at these levels right here, because we started to show some sort of resistance, and I didn't really feel comfortable being long the Nasdaq after a huge gap up, especially given how bearish everything was on the Nasdaq and the fact that we're still in a bear flag pattern, which is a bearish pattern. So yeah, so essentially, right now I'm still just bullish everything. I mean, it's just safe to be bullish everything. But then you keep a stop loss at these support levels. Okay. So that's the safest thing to do, really. 310.90 is a make or break area for the NASDAQ, for the QQQ currently. And then 324.30 is another make or break level for resistance overhead. If we can cross either of these levels, those will be the signs of either bullishness or bearishness, in my opinion. So we have to see how we respond at those levels. Another thing to take into consideration is that the NASDAQ broke above the 23.6% Fibonacci level as well. So the NASDAQ and the SPY broke above the 23.6 Fib level. What's interesting, though, is the IWM has yet to reclaim that level. The IWM today was testing the 38.2% fib level as support. Okay, so that means that, given, especially in a Democrats own all of they own everything, right? They're in charge of the party system, and they have a majority in Congress. So especially during a Democratic sweep, that's what I was thinking of saying. The Democratic sweep. When there's a Democratic sweep, value stocks do very, very well. So IWM is value. The QQQ, which is tech sector, that's growth, right? The growth stocks don't do well. Value stocks do much better. So I'm much more comfortable going long the IWM at support, especially given that in the short term, we haven't even reclaimed the 23.6% fib level, whereas the SPY and the QQQ have, and the fact that we haven't even reclaimed the March 2009 trend line, whereas the SPY and the QQQ both have as well. Okay, so the IWM, I am very biased, bullish. So again, yes, but we have to keep an open mind, and we have to just trade it by the levels. Regardless of what we think, regardless of, oh, look, the tech bubble, there is so much more room. I could be completely wrong about everything that I said. Right now, the most important thing is the levels. Levels don't lie, right? If something is above a certain level, you buy it. If something is below a certain level, you just wait, or you could buy puts, right? You could short against it. So that's what we're doing here. As it touched this level of support today, I literally bought it. I alerted it in on Twitter above 24.20. I wrote it up all the way. I took some profits. I'm still holding a lot of my August calls. Um, but yeah, so that's yeah, we just have to trade the levels day by day. Um, the IWM still has a lot more room to go, in my opinion, given the fact that the tech sector might potentially take a hit, but this is the 10-year yield, right? So the 10-year yield, we can see today it had a red day, but the Nasdaq had a green day. So yesterday I was saying that the 10-year yield and the Nasdaq, the correlation is starting to wear off. So like, if this breaks, then if this level breaks, essentially, right, that might bring the correlation back, because it would signify a change in of momentum, right? And then if the 10-year yield breaks and then it reclaims it, that's when I think the correlation might begin again. So currently, the 10-year yield is not really acting as a correlation factor to the Nasdaq. What else did I want to talk about? Oh, I want to show Apple. Yeah, so Apple, we can see that this level of support from back in October, this is holding very, very nice support. We bounced off of it cleanly multiple times, and we're still above it, right? So that's very, very bullish for the tech sector. So if you're bullish on the tech sector, if you're bullish stocks currently right now, this is a very good sign because Apple is the biggest company in the world and they have the biggest holding in the Nasdaq. So if this is doing well, that means the Nasdaq should be doing well as well. Also, Amazon. Amazon, if you take the Fibonacci level from the March lows to the all-time highs, we can see that we just reclaimed the 23.6% Fibonacci level at 3102. So currently we're trading at, we closed at 3110. So that's also a bullish sign. But, obviously we still have to cross over the 200 simple moving average. And again, obviously we're still in a bear flag. So there's still, it can still either go both ways, literally. That's why we just have to blindly just trade the levels, regardless of where we think the market is going to go, regardless of how bearish you are on the market, regardless of how blindly bullish you are on the market. You have to trade the levels. If you don't respect your levels, you're going to lose all of your money, and you're going to have to, get a job and save up, and then start trying to trade again. It's not worth it. So, one more thing is the dollar. The dollar looks pretty bullish. The correlation isn't completely there currently with everything, but the dollar definitely looks bullish. Let's see if the correlation persists. One last thing I wanted to look at. Yep, the IWM is also above the 20 EMA on the Bollinger Bands. The QQQ also bounced off of the 20 EMA on the Bollinger Bands. And the SPY is trading well above it. So there's a lot of bullish factors today. But overall, I'm much more bullish on the IWM longer term than I am on tech and the SPY. But we will see how that goes. This was a pretty long video. I rambled a little bit, but I'm very passionate about this. So I hope you guys learned something. I hope I provided value. If I helped in any way, drop a like, drop a comment, subscribe to the channel. Just give me your feedback. Let me know how I'm doing. If you want me to go over any charts in my next video, definitely let me know. I'll go ahead and do that for you. And yeah, until next time, thank you so much.